What's going on, guys? In this video, we are going to be talking about why you should own dividend ETFs. Now, no, this is not financial advice. This is purely for entertainment and education purposes only. I think dividend ETFs are a great tool. It's not for everyone, but if you clicked on this video, clearly you've heard about dividend ETFs and you want to know if it's something that's right for you. So diving right in, there are plenty of dividend ETFs. This is Seeking Alpha Premium, and we're just going to look at a handful of the top dogs, or at least the big ones that I know about. We got Charles Schwab dividend ETF. We got the iShares, a couple of iShares, a Vanguard dividend ETF, the First Trust Morningstar dividend ETF, and here's another iShares. Here's all of their ratings respectively. They're all earning a decent amount when it comes to your dividend yields, and all of them are pretty solid ratings. That's because if it is a dividend ETF, chances are it's holding on to a bunch of different blue chip dividend paying stocks. But the one that I'm going to really focus on today is going to be the Charles Schwab US Dividend ETF. This one's probably my favorite, not only because it has performed the best over the long run, but because of the way it's structured, which I'm going to talk about in the very end of the video. It's different than some of these other ETFs, and it is important to know how these ETFs are structured because it may determine which one you want to go for. But if you look over the long run, we're going to put on percentage 49%. This is over the course of, over the course of a year, it's up 16%. Over the course of 5 years, it's up a little over 100%. If we were to compare that to the benchmark SPY, that's APY. Let's try that again. SPY. It's actually beating the SPY over the past 5 years by about 1 or 2%. So that's pretty right on mark where you want to be. It is performing very well, but you need to remember that past data does not predict future performance. So let's dive into what you're exactly looking at when it comes to dividend ETFs. If you don't know what dividends are, I'm pretty sure most of us do at this point. You just jump onto Investopedia. You can read up on dividends. It's essentially companies paying you. You're the owner of a company, and a dividend is you getting paid cash from that company. You could own Apple, and Apple, the biggest company in the world as I'm recording this, can pay you once a quarter being owner. Not all companies pay dividends, but a lot of people will solely invest in companies that only pay dividends. They'll be dividend growth investors, or just regular income investors will seek out dividends. Now, dividends are so much better, superior than your normal paycheck. And the reason why is because of qualified dividends. I'm going to talk about qualified dividends in a second, but you see on the screen, this is at smartasset.com. This is showing your 2022 non-qualified dividend tax rate. So if you're getting paid from a company, whether it's a paycheck or in dividends, you need to pay taxes. If you're living in the US, that's just how it is. When dividends are not qualified, which I'm going to talk about qualified in a second, you're paying your regular tax bracket. So depending on how much money you make a year, including your dividends, so if your paycheck, if you're making $10,000 a year, and then you're making another $200 from dividends, here's how much taxes you need to pay on it. You need to pay 10% taxes on that. So that $200 that you just made in dividends, you are going to owe the government $20. Let's say you're someone that's making $100,000, then you're going to fall into this tax bracket, 24%. So let's say you make $100,000 from your job, and then you make in another $10,000 in dividends, you are going to owe the government $2,400 from that $10,000, or 24%. Now there's something called qualified dividends, which look at how much better the tax bracket is. We are looking at 0%. You're going to owe 0% if you're making less than $41,000 a year. So if we just back up really quick, if you're making less than $41,000 a year, let's say you're making $40,000, you're still owing the government 12%. If you are only making dividend taxes, this is your grand total. So maybe your job, you're getting $20,000, and then your dividend income is $10,000 or $20,000, but it's below 40,000 if you're single, you won't owe any taxes on those dividends. If you're married, that bumps all the way up to 83,000. If you were making between 41,000 and 459,000, which I would bet that 99% of my audience falls within this bracket, this is where I fall in between, you're only paying 15%. So you could be making $250,000 a year, and of that 250,000, maybe 100,000 is coming from dividends. You're only paying 15% on that. That is killer. We go back to your normal, say $100,000 a year, or I said what, 250,000? You'd be all the way up at 35%. If you're making $250,000 a year straight from your regular day job, you're paying 35% in taxes. If you're making $250,000 a year solely off dividends, which you need a substantial amount of money in the stock market to do that, you're only paying 15%. So this is why dividend income is the superior income. It is passive. You make this money in your sleep. You don't have to do anything. You're just holding on to an asset, and you get amazing treatment with qualified dividends. So how do you get qualified dividends? Well, that's simple. You just got to hold. The longer you hold, the better. And to be exact, you need to hold 60 days or more during the 120-day period that starts 60 days before the ex-dividend date. You can look into the ex-dividend date and exactly what that entails. I'm not going to get into that right now to keep this video shorter. But essentially, once you reach a certain point of holding time, then your dividends just automatically become qualified dividends. So if you're someone that's planning on buying a dividend ETF and holding on to it for a year, 10 years, 20 years, you don't even need to worry about this because within the first year, all your dividends are going to become qualified dividends. And then you are getting this amazing tax bracket. Besides maybe the first payment, you might be in this tax bracket, but that's just for that first little payment. So don't get too held up on that. 99% of you long-term investors, I'd say 100% of you long-term investors are going to be getting qualified dividends. This does not count REITs. Keep that in mind. This is only for dividend stocks or dividend ETFs. But let's jump back to the Schwab Strategic Trust Dividend ETF. Why is SCHD my favorite dividend ETF? Well, first off, not only is it beating its peers in momentum, expense, dividends, risk, and asset flow, it is a pretty solid investment. We jump over to dividend yield. We could see right here, it has a pretty modest dividend yield. On the very low end, it's about 2.4%, 2.5%, I would say. And then on the high end, you're looking at maybe 4.3%. So realistically, it's bouncing between 2.5 and I'd say 3.5%. That's where it stays 99% of the time. That's over 5 years. Let's just look over 10 years really quick. So 10 years, you can see it's pretty much hugging that 3%. That's pretty much where it's going to be. That's nothing too crazy. I know there's plenty of companies out there that are paying 4% or more. You also have ETFs that might be generating a higher yield, but that's not what I'm after. I am after stability. I want to be promised that 3%. I want to make sure, regardless of what's happening in the market, if we're experiencing a bear market or a bull market, I'm still going to be getting that 3% all day long. And it has really kept up with that. Now, why is this one special to me compared to its peers? Even if its peers have higher dividend yields consistently, well, that is because of the way this ETF is structured. If we go over to holdings, and if you know anything about me, I like concentrated portfolios. Yes, it is a higher risk, but the Charles Schwab Dividend ETF is pretty concentrated. 21% is in financials, and then we got 15% in the tech sector. And you could actually see, even between that, we got industrials. 3 sectors make up 50% of this entire ETF. And then what might be alarming to some people, personally, I like it. It's pretty concentrated with its top 10 holdings. 40% of this ETF is made up of its top 10 holdings. You've probably heard of most of these companies. Texas Instrument, that's all the calculators we used in high school. Cisco Systems, Broadcom, Pfizer, Pepsi, Verizon, Coca-Cola. These are all big names that we all know about. International Business Machines is IBM. So we all know about these companies. They all pay a solid dividend, and they're not going away anytime soon. They're probably going to be sticking around for the foreseeable future, and they're going to continue to pay out these dividends. Now, I am a strong believer that there are not that many good companies in the world. There's only a handful of companies that are going to make you any positive return over the long run. And it is a gamble trying to guess which one of those companies are. But clearly, Charles Schwab for the past 10 years has picked the winners, and they've been doing really well over those past 10 years. Now, the beauty of dividend ETFs is, let's say for some crazy reason, Coca-Cola goes out of business. It's gone. That's like the golden child dividend-paying stock. Warren Buffett has made millions and millions of dollars, hundreds of millions of dollars a year just off of Coca-Cola dividends. Let's say it's gone. They file for bankruptcy for whatever crazy reason, and they're off the face of the earth. Well, that's okay, because that's only one holding. That's only 4% of this ETF, which, sure, we may feel that in the short term, but before it goes bankrupt, its price will probably deflate. And this ETF may even make those adjustments before Coca-Cola goes to zero. So the beauty about ETFs is it's passive management. You don't have to worry about, oh, which stocks are going to buy this month or this year. They're pretty much going to stay the same. They may make some adjustments each year, but it's not going to be anything crazy. And if some catastrophic event happens to one of these companies, well, then they could easily drop it and pick up a different company, because even though it's very concentrated at 40% for the top 10 holdings, there's over 100 holdings. There's 105 holdings in this dividend ETF. So if one were to start to drop off, I'm sure another one within these 105 holdings will start to pick up and replace. And another thing I like to point out, a huge thing you need to look at is expense ratios. Usually ETFs have extremely low expense ratios, but the Charles Schwab ETF is actually tied with the lowest. The Vanguard also is very low. Look at some of these other 0.38%. That is a huge difference compared to only 0.06%. So not only are they picking winners, it's concentrated, which is something I like, but its expense ratio is extremely low compared to some of its peers. DYV is 0.38%, and FDL is 0.45%. That's robbery, in my opinion, right there. But guys, don't just rely on what I'm saying here. You know about dividend ETFs now. You know exactly what qualified dividends are and why it's so lucrative to hold on to dividend ETFs in the long run. Again, not financial advice, but do your own research. Take a look at, here's 6 different dividend ETFs you could look into. Take a look how they're structured. What are their holdings? What are their expense ratios? What are their top 10 holdings, and how concentrated is it? Is it something that you would feel comfortable with holding on to for the long term? But if you learned something from this video, guys, smash that like button to let the algorithm know that this was a solid video, and subscribe if you're someone that likes learning about stuff like this. Really helps out my channel. But as always, guys, I will see you in the next one.